Welcome to the Doctors Building Wealth podcast. Today, we're really excited to have Tyler Kerlee with us. He has been our insurance broker since 2015 and has taken care of all of our rental properties. He is the owner of Path Insurance Solutions, and we're going to be talking about the current landscape with insurance. There's been a lot of change in the last few years, a lot of increasing insurance rates. A lot of our students have felt the pain, and so we wanted to make sure we took the time to talk to Tyler about what's going on right now and what he expects to see in the next 6, 12, 18 months, and what you should do as an investor in real estate to be able to make sure that you're prepared and that your cash on cash calculations are accurate so that you really do predict how your property is going to perform before you even buy it. So with that, welcome, Tyler.
Hi guys, how are you guys doing today?
Amazing. It's great to have you here. So
Thank
maybe
you.
maybe we could start out just talking a little bit about the current insurance landscape, because I know we've had a lot of conversations about this, but some of the newer people maybe who don't own rental properties might not really understand what's been going on. So could you talk to us a little bit about that?
Yeah, so we are in the midst of what's called a hard market. A hard market is when insurance companies sort of shrink their appetite and only want to take the cream of the crop, which is the most profitable business. Obviously, insurance companies are in the in the business of making money, and so over the past 3 years, there's been a lot of changes that are affecting the marketplace. The most notable one, which everyone is aware of, is inflation. So the cost to rebuild properties has gone up drastically. And we're not talking a little, we're talking a lot. So, for example, where I live, I'm sitting in Redmond, Washington. I would say the average house price is about 1.75 million here. And 5 years ago, we would have used like $175 to $200 a square foot to rebuild a house. Now we're starting at $300 to $400 a square foot to rebuild a house. So that just the cost to rebuild a house has doubled. Now that that doesn't change when it comes to maybe you have like a small kitchen fire and you have to fix the kitchen. All of the costs to fix the kitchen have gone up as well, and subcontractor costs have risen accordingly. And so one of the main factors is just replacement cost, and fixing houses has gone up drastically. Part of the problem during COVID, which we're seeing a leg of in a lot of the industry, auto insurance and home insurance, is that some of the service providers went out of business. So you have a limited number or less people in the industry of like plumbing, electrical, general contracting that were successful enough to keep going through COVID. And so we've had a leg of these people coming back into business. And so when you lengthen the time that a house takes to get rebuilt, they're paying, the insurance company is paying for like loss of rents on a rental property, or if it's a primary residence, they're paying for that person that has to go rent another house while their house is being fixed. So that's one of the factors. Another factor would be severe weather. Now, specifically Florida, Texas, California, which is our main problem children, if you want to put it that way, would be the weather. So Florida has hurricanes. Texas has them all. Texas has fire, hail, hurricanes in the south, and they even had a large freezing event in 2022. I want to say it was. I could be wrong on the year.
No,
Um,
no, that was last year, and it was we have a short-term rental in Dallas, and it was quite an event.
yeah. So and so for an insurance company to math out a profitability sort of actuarial, um, predicting the weather is not easy. And so for example, in Dallas Fort Worth area gets hit with a lot of hail. In Harris County, which is Houston has the hurricane exposure. They have like these, now they're getting these king tides. Even if the hurricane doesn't fully hit them, they get this massive influx of water coming up through to the coast. And then you have the freezing and wildfires there. And then in California, you obviously have wildfires, but this year they got a lot of rain. And so you had mudslide and difference in conditions where houses were literally sloping off hills and essentially falling apart just due to soil erosion. So those are two factors. The third one that most people aren't hearing about, and this is also part of why auto insurance rates are going up. So just a quick side note: in 2024, auto and home insurance rates will go up by 22.6% is what they're predicting, and that's just for your standard auto and home. Now, what was this? On Tuesday, Yahoo came out with an article. I have it up here on my computer, and there's 3 states that what is it? It's California, Missouri, and Minnesota. They need between 50 and 60% rate increases on auto to be profitable. Now, part of the issue with them not having the appropriate rate is the insurance commissioner of each state. The insurance companies have to go to the insurance commissioner and file for rate. And they have to justify why they're increasing their rate, whether it's losses on auto or home or whatever it may be. And so in these 3 particular states, the insurance commissioner has already artificially kept the insurance rates down. To I don't want to go political here, but it's a political reasoning why they're keeping the rates down. It's to make them look better. It's to make the insurance companies look bad. And we've seen this. We've seen this in California. California State Farm just non-renewed 72,000 homes in California. Well, the reason being is that the insurance commissioner isn't allowing them to file rate and factor in cat losses. They want them to be able to insure 85% of the available insureds. Well, if you're going to insure 85% of the available insureds in California, then you have to insure people in wildfire areas. And the turnaround process on these rate filings is 18 months. So we all know how data works. If we have data now, it's probably bad in 2 to 3 months. So if we have to wait 18 months, then the data is definitely not accurate and it needs to be adjusted. So filing the appropriate rates and getting the appropriate rate in these states is part of the problem. But the thing I wanted to get to here was liability claims. So since COVID, liability claims increased by 40 to 50%. So just the frequency of filing the claim has increased. Then the frequency of the payouts has increased because the juror selections, they're picking good venues, they're picking sympathetic jurors, and the awards to the injured party in these claims have gone up 40 to 50%. I'll give you a very scary thing that happened here in Seattle. So one of the companies I brought in in the last 2 years is Capital Insurance Group. They're a great local regional carrier for California, Washington, Oregon, all these states. They insure apartment complexes. We write a lot of apartment complexes, so I brought them on. This was not my insured, but it was in Seattle. You have the apartment building and then you have the sidewalk. Well, the city of Seattle owns the sidewalk and they have a planter box on the sidewalk, but not owned by the insured. City Seattle is responsible. Well, there was a marathon runner. She was 54. The sidewalk or the planter box created a little bit of mold and slippery area. And this marathon runner was actually walking. She wasn't running. She slipped on that and literally both of her quads tore off of her knees.
Wow.
And so they sued the city of Seattle and they sued Capital Insurance Group and the building owner. Well, Capital Insurance Group says, hey, look, we're not responsible for the sidewalk. We're going to fight this. Well, when a insurance company fails to settle a lawsuit within the limits that they are allowed, and they say, hey, we're going to fight this, that opens the limits. It doesn't open the limit to the insured. It opens the limit to the insurance company, and they're responsible for the overage of the additional, loss. So it went to court. Um, the insured was found guilty of having a sidewalk that he had no care, custody, or control over, and it's called a nuclear verdict. The nuclear verdict was $30 million awarded to the injured party. And so what you're seeing now, this is leads up to what I'm going to say here, is what you're seeing now is lawyers are teaming up with liability claim harvesters. So you'll see these on Facebook, Instagram, cold calls, ads on TV, ads pretty much everywhere where you can see an ad. You're going to see a have you been injured? Have you slipped? Have you fallen? Have you been injured? And what lawyers are doing is they're partnering with these sort of claim harvesters, and the claim harvester gets 20% of the payout. And so these people are looking for nuclear verdicts. I can, in my own circumstance, I've been doing this for 20 years. I've had one slip and fall claim until this year. 5 slip and fall claims this year. 2 of them happen to be members of semi-retired MD. One of them was in California, which is sort of the where it started. So California was sort of the developer of this process, and they've had the court systems and whatnot to be able to get these verdicts. And so insurance companies, if they decide to fight these, because a lot of them are unwitnessed, so it's I got hurt, no one witnessed me get hurt, I'm going to sue you. And then the insurance company naturally is like, well, we're not paying you $1 million for this. You didn't get that hurt, and no one saw it. So they try it, and then if that lawyer can open up the limit, meaning they want to fight it, open up the limit, they can get a nuclear verdict. And so this is really affecting property insurance. You wouldn't think it, but when you get, we're only insuring these houses for around $2,000 a year, maybe give or take, depending on the area. If you have a nuclear verdict of $2 million, how many houses does it take for the insurance company to make up that difference, to make up that expenditure? So, those are the main things that are affecting the rates. So to recover this, we've got cost to replace houses. We've got severe weather. We've got these nuclear verdicts, and sort of liability harvesters. And so and then we have the insurance commissioners not letting insurance companies get rate fast enough. And I understand that they're going to give them incrementals of like 15%, but a lot of these companies need 50%. So what they do is, if it's an annual policy, they're going to take 20% every year, and they're still behind on rate.
Mm.
So yes, your policy will go up in cost this year. And even if you haven't had any claims, or you're a good driver, nowadays we're actually recommending that you fix your window out of pocket. So like on your car, if you get a rock chip, pay for it out of pocket. I just had to pay $1,000 to get our BMW window replaced, because I'm not going to file a claim. And so what we've done for our investor clients is say, hey, look, minimum deductible you should have is $2,500. We're even suggesting higher now to reduce the cost. But at the same time, you're never going to make a claim that low, because you can't afford to have multiple claims on a house. Even if it's not your fault. We're running into a situation right now in Bellevue. It's called Clyde Hill. It's maybe one of the most expensive areas in all of Washington. We have an insured we're working with there. He had one water claim, and he bought it in 2022. He had a water claim in 2023. But
Mm-hmm.
the previous owner had 2 water claims in the last 5 years. So there's 3 water claims on that house. We can't get it insured through a standard carrier because the house has had 3 water claims. So we have to go to another provider, and his insurance cost is it's going to go from about $3,500 to somewhere around $12,000. And he did have one claim, but it, we can get stuff insured for one claim. But the history of the house says a lot about what an insurance company thinks they can expect. It
Mm.
doesn't mean, maybe the previous owner was bad, but they have to go off what they factually know. And so we're seeing a lot more denials on property purchases where there was an existing loss at the house, and typically it's revolving around water. You can't really associate a liability claim to the previous owner and attach that to the new owner, because that's something under your care, custody, and control. And so those are the types of things that are changing the landscape of insurance. And so to reiterate, we're not pay for your class claims out of pocket, pay for your towing out of pocket. um, and then one of the big things that I want your guys' community to know is, when you're looking at a house, you look at the house, and obviously from an investor perspective, sometimes you want to buy a house with a lack of maintenance because you get a deal, right? We're looking for deals, so we can buy it, we can fix it, and we can refinance it and either rent it or sell it. It's either fix and flip or buy and hold with a appreciation strategy. So when you're looking at these, the insurance company is looking at a depreciated house. So they're saying, hey, the paint's chipping, the siding hasn't been redone, the roof hasn't been redone, and they don't want to insure it. So going into this process, a very big thing to think about is, what does it look like to the human eye? And if you can honestly say, gosh, this needs to be fixed, this needs to be fixed, well, then the insurance company is going to say the same thing. Now, in order to prevent issues with the house moving forward, if you buy this house and you don't let me know or your insurance agent know, and they put it on the wrong policy, sometimes the insurance companies aren't willing to reinstate. If they've issued the policy, the inspector comes out and says, hey, the roof needs to be replaced, or there's trees up against the house and the siding is peeling. Sometimes, specifically in our trouble states, which are Texas, Florida, anything along the coastline, the Gulf Coast, anywhere where the hail. Oklahoma is a terrible state right now. Any of those states that have severe weather, um, we're going to want to put it on a renovation policy to start, and then move you to the long-term rental policy. If we try to just put you with that cheap policy to start, or I'm not aware that there's issues with it, because we can only see so much from the internet, then, like, we just ran into this with someone and they didn't let me know that they were renovating it, and we wrote the policy through Safeco, and Safeco's unwilling to reinstate it, so we have to move to a higher price insurance company.
Mm.
Whereas I could have just put it with the high price insurance company for 2 months and then moved it to Safeco. So it's letting your insurance agent know, and understanding that houses are being scrutinized more so than ever before is very important when it comes to the investment process. And it will save you a lot of pain and headache and frustration if you just attack it right away. It's like, you can't let a sore on your arm just sit there and fester. You want to get it fixed right away. And that's the same with the property insurance marketplace right now. It's really crazy. And I don't think we're going to be going back very far from this. I think this is going to be the new norm when it comes to underwriting a house. For example, Travelers is one of our main companies we write insurance through for your guys's, for everybody that's listening here and in my office. And so they have their own aerial imagery software now. And so for every house we go and we look at the roof. The roof is one of the big issues with insurance being profitable nowadays. And so these roofers will have aerial image, like they'll know if a hailstorm happened. and they'll go door knock in that neighborhood, like, hey, you had a hailstorm, 2 weeks ago, you can get your roof replaced for free.
Hmm.
And it's like, well, wait a second, is the entire roof destroyed, or is it fixable damage? And so they're creating this large claim scenario in areas where, you know, it's an issue for insurance companies, because if they have to pay out, you know, 30 roofs in Dallas Fort Worth, they're not making a profit. And
Okay, so I just want to summarize because you've gone through a lot. So
yeah, yeah,
first of all, I wanted to just highlight how you want an insurance broker, not
yeah,
just work directly with the insurance company, because you need to be able to have somebody like you who you can call and talk to about the situation, who can advise you ahead of time whether or not you should be calling your insurance agent and notifying the insurance company, because this has been always our common practice is to rarely make any claims, but it sounds like
yeah,
that's even more important now to not make claims.
yes,
um, Probably 4 or 5 years ago, we increased all of our deductibles because we realized we were pretty much never going to make a claim unless something catastrophic happened. And so that's what we did to help, keep our insurance rates somewhat reasonable. So
mhm,
I just want to highlight that you said that to people too, is that you're seeing them increase their deductibles, because it's going to be very, very rare that you actually call a claim on your insurance. And before you even call the insurance company, you need to talk to your broker and see if it's worth
yeah,
it. And I just want to highlight, like recently we had a drunk driver, right, drive through all
yeah,
those fences behind one of our properties. And the neighbor did call their insurance company, and the insurance company told them the fence was too old. They're not going to pay for it. And you had told us the same thing. So we didn't bother to call the
yeah,
insurance company, but now they have record of their call. So that is not
yeah,
good. I also wanted to highlight how you're saying that you're seeing a lot more people make claims, and some of these claims cannot be substantiated at all. We've seen that as well, and it's very concerning. And I'm not sure what can be done. I'm sure there has to be some sort of adjustment with that at some point, because it seems like
yeah,
it's pretty out of control if 40 to 50% up, as
Then,
well.
yeah, then you also talked about the strategy of when you buy a property and you're thinking about insurance, it's not just go out and get a policy. If you are fixing it up, like a lot of people in our community are fixing up their properties, get that more expensive renovation policy for a short term, get the property to a place where it's insurable, it looks good,
yeah,
it's looks good to the human eye, and then the insurance company is going to look at it at that point and go, okay, yeah, see, I agree, this property looks good, it looks insurable, and then you're going to be in a better position. And you're not going to be in a position, like you said, where they're not going to write a policy for you because you did it the other way, right? You want to
yeah,
make sure you do it in the
yeah,
right order, as opposed to doing it where you get the regular policy first, and then the property has all these issues.
I also want to
yeah,
highlight an opportunity, which you mentioned, which is if an insurance policy is not going to insure a property because it's got some, peeling paint, or it's kind of beat up, or the roof needs to be replaced. Because I think that's actually an opportunity for us investors to negotiate even harder with the
yep,
seller and say,
yep,
hey, here's a letter from our insurance broker. It says we're not going to be able to get insurance with all these things. Just so you know, any other buyer who comes to you is not going to be able to get insurance because of all these things. So we need you to fix all of this before we take over the property. And we want an independent inspection to make sure it was fixed accurately and adequately before we take over. And that allows you to come with less money out of your pocket for those things that, don't add any rental value, right? Whether or not there's a
yep,
roof that's 2 years old or new, it's not going to be able to make you charge more in rent. So it's irrelevant to you as a real estate investor. But if you can get the seller to pay for that roof before you take over, that's going to help you not only get better, be able to get insurance, but also ideally be able to get a better insurance rate than you would have.
yep.
And it's a negotiating power that you now have. So just make sure everybody that you take advantage of that.
Yeah, that's a very, very important point. I think that sort of your best friend when you're looking at a property to purchase is your inspector. Besides, someone like me that's going to give it that advice, but like an inspector is going to be there. And so some of the things that you want your inspector to do every single time would be sewer scope, number one. Number two, check the roof. Number three, check the electrical. Number four, check the plumbing. And number five, check the HVAC. Those are the five systems of the house that you want to verify that are in good working order. They're the most expensive to fix. Oftentimes they won't be covered by insurance because a lot of times they're if it's wear and tear, wear and tear is not covered. It's sudden and accidental damage is the language in the policy. And so in order to prevent capital expenditures, once you take over a property, that's the easiest way to save yourself from a big loss, is having a really good inspector, and then use that information the inspector brings back to you to negotiate the price either down or have them fix it before you take over. So those, I mean, I think that's the most important thing you can do when you're buying, especially when you're buying older houses. You know, if you're buying something 2000 or newer, it's important, but not as important as like if you're investing in the Midwest and you're buying something in the early 1900s. It's a must do, and you can definitely negotiate price for the time being. Maybe once if interest rates go down considerably, then we're going to be back into this no contingency buying process, which is dangerous, and you'll still probably want to throw in an inspection contingency even at that
Absolutely.
point.
Always. That's
Yeah.
our community does that.
Yeah.
Yeah.
Now you mentioned in California, State Farm had pulled out of all those homes. And we know that the same thing is happening in states like Florida and Texas, where the major insurers are pulling out. We've seen some articles and reports about that. Question for you is, like, what happens when that happens? Like, do other providers, maybe local providers or smaller providers, step in, or is there just a big void in the market where it's very difficult to get insurance?
Okay, so I think you'll probably always be able to get insurance. It's just at what cost, what coverage, and what quality of company. So, like, for example, in California, every insurance company that I know of has stopped writing new business in California for rental properties. Now, you can still find a few carriers that'll write homeowners insurance in certain areas. So the main thing is there's two forms of companies that write insurance. There's called admitted and non-admitted insurance companies. Admitted means that this insurance company is approved by the state. It's state backed. So if there's large losses, the state is guaranteeing that they will pay out their claims. A non-admitted company is not state backed. So if they have a lot of losses and they can't pay out their claim or their policyholders due to insolvency, you're sort of out of luck. Maybe the government comes in and assists, but you don't want to rely on that. Unfortunately, in California, we're stuck with going to non-admitted carriers, specifically in areas where there's brush. If you have any brush around your house, it's probably going to a non-admitted carrier. And this is temporary. In California, I've heard two things that potentially it will come to a head in December. The insurance commissioner has to redo some of the rating philosophy within the state. They're not allowing cat losses to be factored into rates in California currently. The insurance companies want that, obviously, because then they can factor in wildfire into their rate. So that's one of those things. California is coming to a head, but I've also heard that it won't be like completely ironed out in December. You never know until it actually happens. As for like Florida and Texas, Texas is open in certain areas. It's difficult for insurance in Harris County, anything on the coast, and then the greater Dallas-Fort Worth area. You know, companies are still operating in San Antonio, Austin, sort of that southwest of Dallas area. We have a lot of companies pulling out of Oklahoma, just due to wind and hail. And then Florida I'm not licensed in Florida, so I can't speak specifically. I just know how insurance works. A lot of the carriers, if you're inland, you're probably safe. If you're coastal, you're going to end up with a company that's smaller, that's non-admitted. The coverage is less. Like one of the ones I run into a lot is Kin. And I've looked at their policy. It looks like they only offer $100,000 of liability. that's their, I don't know if that's their max, but every policy I've ever seen from them is 100,000, which is zero. Um, that doesn't, I mean, that gets you like maybe one little hospital visit. It doesn't cover a lawyer. And so, yeah, in those areas where there's severe weather, you run into admitted and non-admitted companies. If you can be with an admitted company, you always want to be with an admitted company, just due to the protection of the state.
No, Tyler,
So,
I have two questions I really want to make sure we answer. Number one is if somebody's going and starting, going to buy a property for the first time, how are they doing their cash on cash calculations? How are they thinking through future years? And then also I want to talk through if somebody owns a property and all of a sudden they get a note that says, your insurance going up by 50%. Is there anything they can do to try to reduce their insurance? Because we've had a lot of people be able to successfully do that in our community. So I want to make sure people know about those two things. So let's start with the new person going out. They're going to buy a property. They're doing their cash on cash calculations. What are the steps they need to take to talk to you to make sure that they have the right number going in? And what should
yeah.
they factor in for the second year or third year?
So the main thing is if you're already set up with us, we have your information. Otherwise, you can get set up through us. Kenji and Letty have a great team to help do that. What we want to see is like if you're interested in a property and you think this fits for the cash on cash calculation. For one, never trust the rate that you see on Zillow or Redfin or any of those websites. Those are way out of date, and you can't just rely on that. So if you like it, you feel like it's going to fit your buy box, then send us the address and let us know your plan. Plan meaning if it looks ugly, you're going to need to renovate it. And then, so we'll do a renovation policy, which won't fit your cash on cash, or it will make your cash on cash look uglier. And then the long-term or short-term rental policy afterwards, which will be a lot cheaper. And in that process, if you're new and I've never met with you before, I can hop on a Zoom call much like this. I can share the technology I use to look at the roof, to look at the house, the pictures and the things I see. So you know what you're truly getting into. And then we'll put together quotes for you based off that information. We quote it through, we're working with all of the major providers that aren't captive. So captive companies are the ones you see commercials for on TV. Most of my companies you won't see commercials for, which is a lot of times why they can provide better coverage at a better price. But the main thing is to shoot us that address. We whip it out pretty quickly. I have one person that works for me and just does quotes. She does them all day long. I'm sure you've seen her name before. Her name is Jade. She is wonderful, and she lives in the Manila, Philippines. And now her cousin works for us, Mark, and Mark does all of our remarkets for our staff. So, and like I said, what can you do for current people who own current properties? We get a report somewhere between 30 and 45 days before it actually renews. It gives us a dollar figure and a percentage rate increase. We're not touching houses if it's only 15%. So 15% is you got a renewal offer, and that's a great price. Now, if it goes when I earlier said the rate increase across the U.S. is going to be 22.6%. That's not like everyone's getting 22.6%. Some people's policies won't go up at all. Some people, if you have top tier credit above 800, new house, in a great zip code with zero crime, your policy might go down. We haven't seen it very many times. My policy went down by 97 cents this year. So I was one of the few. So my staff looks at those every morning. We get a report every morning. We look at that. We evaluate the ones we're definitely going to reshop. Mark starts shopping them, and then depending on your alphabet, you'll have one of our account managers contact you with what we found to see, and then we'll move you. Ideally, we don't want to move you because that loyalty and length of time with that company helps if we ever have to move you down the road, because there's tiers. These companies use I don't know, like Safeco has 100 tiers. And one of the factors that ranks into your tier system is how long you've been with your previous provider. So we don't want to move you every year. That's not good for you. So that's why I said if it's only going up by 15%, we're keeping you there and be happy. But if it goes up by more than that, or if you're paying just, say you're paying $8,000 and it goes up by 15, 20%, obviously we're going to shop you because that's that's $1,000, $1,500. So we go by a dollar figure percentage. And so that's how we help our existing clients. For our new clients, we just do the same thing, but at the very beginning. So it is a constant process. Like I said before we got on here, I had to hire 2 people just to keep up with that for this year. So
Tyler, if you're looking at your cash on cash calculation, should you be factoring in like 20% just to be safe for insurance costs to go up the previous year after you buy the property? Or how
yeah,
do you manage risk with it?
I would say that 20% is fair. I wouldn't call it per annum, but I would factor it in for your first 3 years of ownership, and then maybe reduce it down to like double inflation, whatever that number is at the time. Like in the past, you could use 3.2% for a long period of time. So just factor in 6.5, and put that into your cash on calculation. And you should always have a some sort of a cushion for these capital expenditures to update the house. One of the things I want to cover here, which I briefly touched on, was roofs. This is my prediction. I have not read this anywhere, but math tells me this is what they're going to do, and this is how it's going to happen. So, for example, in Texas, Florida, anywhere where there's wind or hail, most companies are going to an actual cash value payout on the roof at 10 years. So if it's 10 years or older, it goes to an actual cash value payout, meaning most roofs are 30 years. So if it costs you $20,000 to replace your roof and you have a 15-year-old roof at actual cash value, they're going to value the payout on that roof at 10K. You're responsible for the other 10K. But you also have a deductible. In these states, for wind and hail, a lot of them are now requiring 1 or 2% deductibles, or even higher. But most are right now at 1 or 2%. So if you have a $250,000 dwelling coverage on your house, you have a 2% deductible, that's a $5K deductible for your roof. So out of a $20,000 roof, the math gets it all the way down to they're only paying $5K for the roof. What I'm trying to say is you're going to see roof coverage go away. They aren't going to completely remove it, but for old roofs, it will not exist and you're out of pocket. So what does that mean for an investor? What we covered earlier with the inspection is that if you see a roof, you're going to buy a rental property in, let's call it Phoenix, Alabama. And that roof looks like it's 15 to 20 years old. There's no coverage for the roof. You're on the hook for that roof the second you buy the property. Now, either you have a plan to replace it or you negotiate that at the time of purchase. I would recommend negotiating that and using this example of why you should negotiate it, because it has zero value from an insurance perspective. So that's a very big one that I think can save investors a lot of money, and they need to know starting now, because it's been happening over the last year, and I can only see it spreading throughout the US, where these roofing companies aren't going to get away with going into communities and replacing 50 roofs on a community development because they were 15 years old. They're just not going to be able to get away with that anymore. And so you have to have that cushion to be able to afford to replace the roof at all times, especially if you're going to sit on it at an older age. And like, I'm considering putting a metal roof. I'm just about to get permits on my property in just 3.5 miles up the road from here, which has taken me absolutely forever. Know your jurisdiction. That's a personal recommendation, not an insurance guy. Know the county jurisdiction and how they treat the permitting process, and the short-term rental process is important too. If you have questions about short-term rentals, I can let you know areas not to buy because it's oversaturated. Like, for example, Indio, California, do not buy a short-term rental in Indio, California. I insure 40 of them. There's no way you can make a profit in Indio, California right now, unless you have like the coolest house on the planet. But Coachella is not every weekend. I don't know how many concerts they have there, but I think they have 2 or 3. But it's like, that's an area, Serville County in Tennessee, up in those there. We insure some beautiful log cabins up there, great properties. But I mean, you're competing with these properties that have been there for a long time, and so there's areas that I feel are oversaturated, and you'd be better off looking somewhere else. And then you have to know the jurisdiction. California is putting requirements, and you have to file for the ability to have a short-term rental, and you have to have $1 million of liability. So there's just areas that you've got to be careful of, especially for short-term rentals. And then if you want to do any sort of building like I'm doing King County, I don't recommend doing it in.
So before we close, I just want to ask one more question. In the very beginning, you kind of talked about this being a tough time in the market. So does that imply that there's going to be an easier time at some point, or do you kind of anticipate that, there's going to be this increase in insurance rates over time? Maybe not as big of an increase every year, maybe smaller increases. I mean, in other words, is this insurance market, is it cyclical, or?
Yeah, it's cyclical. It
Okay.
is. When I started in 04, we had a minor hard market starting in 05 through like 07. And so it's cyclical. My prediction is we're going to start seeing a little bit of easing mid 2025. If interest rates come down, that will definitely help. The basic math of an insurance company is they take in $1 and they want to pay out 97 cents. And so they're on a 3% margin. In 2022, 2023, industry average was somewhere around, they took in $1 and they paid out $1.11. So that says to get back to a 3% margin, you need to take at least 15%. With factors like, with the whole car insurance market's a mess, because if you touch my car right now, it costs $10,000 to fix just because it has sensors. Every car has a sensor now. It has a backup camera. I got a video of one of my clients, Rivian, getting rear-ended, which was sad but cool because you could actually see like what happened. And so the insurance companies have to figure out what the cost is to truly repair those, what the turnaround time is. There's a big lag in fixing cars right now. And so I think, with the development of AI and some other things that will be factored into the insurance rating process here in the near future, I would say you're going to see some easing mid 2025, but like we should be getting closer to a soft market by 2027, which means they're not going to go away from micro analyzing the condition of a house. That is of the past. Everything will be aerial imagery moving forward. And one of those things you need to think about that we only have one company doing this right now is if there's tree overhang. So on the aerial imagery, if trees are overhanging the roof by more than 10%, they won't even write it. So if you find, and they happen to be one of our best companies, and they have the best rates. And so a lot of times what I have to do is say, hey, you need to trim those. You got to have someone come out and trim those trees before I can even issue it. So even if it's a good looking house, but there's trees over it, sometimes that could be an issue where we just put you with like one of our renovation companies while you get the arborist out there, and we switch you, in 2 weeks or whatever it may be. So those are, but to summarize, mid 2025, as long as interest rates come down, we should see some easing, and then 2026, 2027, and then I would expect you you can just go off of somewhat of an inflationary type of number. One thing to keep in mind, all property policies have an inflation increase of dwelling coverage. So most of them are 3 or 4%. So if you have a $200,000 dwelling coverage, the coverage goes up to 2,000 and 8,000 every year. It increases by 4%. So you'll see a minor increase in your cost every year just due to the coverage increase. So
Mm.
those are minor things to think about. But yeah, I think it'll settle out. It'll just be our new norm when it comes to actual the 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 condition of the house, that we're going to have to deal with that moving forward no matter what.
Yeah, and for people doing cash and cash calculations, generally rent rates are generally increasing by inflation at the very least, if not more.
Yeah,
So when you're looking at your cash and cash calculation for 1 year, yes, some costs would be going up. Ideally, your rent rates are also going up, unless it's, a tough time, right? Unless there's a recession, that may not
yeah,
happen, and you just need to be aware, and you have to always build in some cushion and make sure you have good reserves.
yeah.
Thank you.
Cushion and reserves are important.
Yeah. Yeah. Thank you so much, Tyler. It's always so enlightening to speak to you, and thank you for sharing all this information with our community. I know it's going to help a lot of people to just really go forward and understand, risks and how to think through them, and how to
Yeah,
think through what actions they should take when choosing their insurance. We're really grateful for your time. So, and we'll
yeah.
put a
Thank
link
you.
below on how to get a hold of you for people too.
Awesome. Thank you, guys.
Thank you.